You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Friday, everyone. I hope you're having an incredible, positive, and uplifting start to your year. Today, we're going to be talking about a really interesting but misunderstood strategy that you can use to reduce your tax bill using a Roth IRA conversion. But first, as always, a few housekeeping items. If this is your first time listening or watching, then thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, CASH stands for creating affluence, success, and happiness. And that's my mission. I hope that you learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often and feel free to subscribe on iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koos and on Instagram at Financial Surgeon. Last but not least, all links, visuals, charts, and other educational resources are available on our website, but today's podcast is going to be completely and 100% verbal, so there's not going to be any visual aids. If you'd like to get some more information about Roth IRA conversions, whether they might make sense for you or someone you know, perhaps a parent or a grandparent even, please by all means reach out to us and let us know. We'd be happy to answer any questions they might have. You never have to be a client to ask a question. So let's go ahead and dive in. I always like to start with a quote, as I do in every single episode. And today's quote goes like this. It's Arthur Godfrey. He said, "I'm proud to be paying taxes in the United States. The only thing is, I could be just as proud for half the money." So I think that's a good start to our discussion today about Roth IRA conversions. And before we even talk about strategy or how it benefits us or who it's good for, let's talk about what they are and how they work. So first and foremost, what is a Roth IRA conversion? A Roth IRA conversion, it isn't even what it sounds like it is. Most people don't realize that what you're doing with a Roth IRA conversion is you're converting a portion or all of a pre-tax asset that's being converted into a Roth IRA, so into an after-tax Roth IRA. So you're not converting the Roth. Technically, you're converting other assets into a Roth IRA, or basically transferring them into a Roth. The second thing is that a Roth IRA, once converted, can then grow tax-deferred, and it qualifies for tax-free withdrawals going forward. What's the catch? Of course, there's a catch, right? You can't just convert your pre-tax assets like IRAs, 401ks, 403bs, deferred comp plans, 457s, STRS, SCRS, PLOP. You can't just convert this without paying any tax, right? So that's the catch. You have to pay the tax at your income tax rate, whatever that happens to be, in the year that the conversion is implemented. And by the way, when you convert pre-tax assets, of course, the amount of that conversion raises your income, which obviously raises your tax bracket. So you have to be really careful how you do this, when you do it, and let's talk a little bit more, I guess, about that. So how does it help? Why is this a good thing? By paying the tax on the pre-tax asset right now. So when I say pre-tax asset, remember, I'm talking about 401ks, 403bs, deferred comp plans, TSPs through the federal government, so pre-tax retirement plans, typically employer-sponsored retirement plans, but also traditional IRAs, rollover IRAs. So by paying that tax on the pre-tax asset now, when tax rates are historically relatively low, the newly converted after-tax money can then grow tax-deferred, and when withdrawals are taken, they can be taken tax-free when tax brackets could be higher. Now, this can especially be beneficial if it's taking place in a year when your income is exceptionally low, or perhaps there's going to be several years where your income is going to be exceptionally low. And why is that good? Well, if your tax rate is low, then that gives us more possible opportunities to pay that tax when it's even cheaper, because not only are tax rates relatively low by historical standards, but if your taxes or your income is low, then that creates kind of a double whammy in our favor. A little tip here, kind of a secret tip. Not converting so much of the pre-tax assets that the conversion pushes your income tax bracket up to levels that would not be surpassed in the future. So we don't want to convert so much of our pre-tax assets to the point where we're paying so much tax. In other words, we've driven our tax bracket up high to the point where now we would never pay a tax rate that high in the future anyhow, even if tax rates were to go up. So we have to be careful by strategically converting by dollar amount up to a certain tax bracket. So if it makes sense to convert up to the 15% tax bracket, which would be unlikely but possible, or up to the 20%, maybe we want to keep you below 23% or something like that. So depending on the tax year, what the tax brackets are in a given year, this is going to change throughout the years. But generally speaking, we don't want to convert a huge lump sum necessarily and then end up having to pay all kinds of tax at a very, very high tax rate. Let's just say at the highest tax rate, and then in the future, tax rates never get that high. So let's just say you converted and paid 30%, but tax rates for you never even get close to 30% again. Obviously, that would completely blow up the strategy and render it worthless. So moving on, what are some common myths? And this is really important because these are my pet peeves when it comes to Roth IRA conversions. I think many times, unfortunately, these are used as sales tools more than they are used as a true benefit to the client. To do a Roth IRA conversion properly, analysis needs to be performed. This isn't something that you just wing. You don't just go out there and say, I think I'll do a Roth conversion today. How much? I don't know. Let's just do $20,000. That sounds good. All right, $20,000. Pay the taxes and see what happens. It doesn't work that way. You got to be more detail oriented when it comes to this. Otherwise, again, you could blow up the whole strategy. So first of all, first myths, Roth conversions are great for everyone. That's not true. Many times, especially people who are still working, who are earning income, whether you're single, married filing joint, or married filing separately, many times your income is too high and thus your tax bracket is too high to where if you were to convert, you're adding income or taxable income to your earned income, which would thus drive your tax bracket up even higher. And then what happens is, again, you end up paying such a high tax rate on those assets that even though taxes may go up in the future when you're retired, they may not go up that high, so it might not make sense to convert. Second myth, when converting your IRA to or 401k to a Roth, let's just say, I've heard people say, well, I'm just going to use the IRA, or I'm just going to use the 401k and I'll pay the taxes with the IRA. So for example, if you have a $1 million 401k and you say, well, I want to convert 25% of that, which would be pretty high, by the way, but I'll just say I want to convert $250,000 to a Roth, and I'm just going to use that $250,000 and reduce the amount of the conversion by the amount I have to pay in taxes. That's not a good idea. I mean, really, if you're converting any kind of pre-tax asset to a Roth, what you want to be doing is you want to be using non-qualified assets, in other words, after-tax money like checking, savings, brokerage assets, joint accounts, trust accounts, things of that nature to pay the taxes. You don't want to use the IRA. It kind of defeats the purpose. The whole point here is to take this pre-tax asset and make it all tax-free in a perfect world. So that is also a myth. Third myth, Roth conversions result in tax savings for all of those who implement them. That's not always true either, which is why we need to do the analysis and make sure that depending on who you are, how much money you make, whether you have a pension or not, whether you're taking Social Security or not, how much earned income you have, if any, how large your retirement accounts are, and that goes again for 401ks, IRAs, 403bs, 457s, deferred comp, TSP, any types of pre-tax retirement assets you might have. We need to have an inventory of those things, and we need to look at your tax return, and then we need to build a projection. So that they don't always result in tax savings for everybody, which is why they don't make sense for everyone. Moving on here, if we've talked about kind of who they don't make sense for, what some of the myths are, let's talk about who they do make sense for. So Roth IRA conversions are best for people who are retired. Now, that doesn't mean that if you're not retired that a Roth IRA conversion does not make sense. I want to make that very clear. It's possible that it would make sense if you're working, but again, it depends on a multitude of factors. But generally speaking, if I'm going to use rules of thumb here, they're best for people who are retired, who again also have pre-tax assets. So that's number two, So 401ks, IRAs, 403bs, deferred comp, STRS, PERS, TSP, any kind of pre-tax asset that's never been taxed before that you've been saving your entire life or you've inherited, something like that. The third thing or third person it might be good for is somebody who worries about paying taxes later in life. They're worried about tax rates going up or their tax rate going up or both. And then maybe these people are also people who they're worried about passing assets that have never been taxed to their kids, who then have to pay the tax on the inheritance. Now, there used to be a rule where you could name your beneficiaries appropriately, pass your IRA, 401k assets, your pre-tax assets, IRA assets, on to your kids, and do what's called a stretch IRA, and then stretch the taxes throughout their lifetime. That changed at the end of 2019, beginning of 2020. Now going forward, what happens is you can still stretch it out, but you can only stretch it over 10 years. So your kids or grandkids cannot stretch it out, say, over the course of 20, 30, 40 years and make their RMDs. RMD stands for required minimum distribution. They can't make those super, super tiny anymore and mitigate those taxes as well as they used to. Now, stretching it over 10 years is still great. It's a whole lot better than obviously taking it all in 1 year, right? But at the same time, it's good to understand that even though a Roth IRA conversion might not make sense for you, there is still the option, if it doesn't make sense, where we could set up beneficiaries appropriately so that your heirs, whether that be kids, grandkids, or what have you, could then stretch those IRAs out over, say, 10 years of their life going forward. And what that means is that they take a certain amount every year over the course of the next 10 years, but all of the IRA or all of the pre-tax asset has to be liquidated within that 10-year period. Of course, they could take more if they wanted to, just to be clear. And then the fifth type of person this might make a lot of sense for is, and this is crucial, somebody who has non-qualified assets to pay the conversion tax. So again, this goes back to what I was just talking about a second ago, where if you have an IRA, let's just say you have several retirement accounts. Let's just say between you and your spouse that you've been saving your entire lives. Maybe you're close to retirement or you're retired already, and you've got a 403b, and you've got a pension that you're going to come into, and you might be looking to take the partial lump sum option plan, or let's just say you're a police or firefighter, and you're looking at the deferred retirement option plan, which is the drop. Let's just say you also have a 401k. So if you have all these pre-tax assets, which is awesome, but you don't have a substantial amount or enough after-tax money in the bank, joint accounts, individual accounts, trust accounts, savings, CDs, if you don't have enough after-tax money to pay the tax on the conversion, then there's a good chance it might not make sense. So if you do have non-qualified assets, however, that would be a really good reason why this might make a whole lot of sense for you. So some caveats and catches before we close out here. Again, I want to make it super, super clear. You can't just convert a pre-tax asset to a post-tax asset without paying the tax. That's kind of how the government makes their money, right? That's how we pay our taxes. Second of all, it's best to do Roth IRA conversions in years when your tax rate is low, and of course, when tax rates in general are low, when tax brackets are low. Again, we want to use using the pre-tax asset, such as the IRA, 401k, or what have you, to pay the tax can again render the entire strategy worthless. So we ideally don't want to do that. We don't want to use the IRA, or we don't want to use the asset being converted to pay the tax. And then if you're under 65 years of age, and this is important, you may, depending on who you are, need to keep tax credits in mind for the Affordable Care Act. Now, that might change, obviously. We just had an election. We just had an inauguration. So there might be changes with the ACA going forward. We have no idea, but we'll have to see what the next, several months or the next couple of years brings us. But for now, we still need to keep the ACA in mind and the tax credits. And if you're over 55, if you're over 65, you need to keep Medicare Part B premiums in mind. So that's important to pay attention to how much you convert, because your premiums is important to pay attention to. Last but not least, if you're wondering right now at this point, if this juncture, is a Roth IRA conversion right for me? First of all, reach out to us. we can do an analysis for you, comprehensive analysis. We use a piece of software that we plug in a bunch of information for you, including information about your tax situation, your investments, your different types of retirement accounts and non-qualified accounts, pre-tax and post-tax assets. And then what we do is we work together with a CPA that we trust, or if you already have a CPA that you have a great trusting relationship with, then we will just work with them. And we help kind of work as a team together, our team and the CPA, to make sure that this makes sense for you. And then once the analysis is complete, what we do is, again, only if a conversion does make sense, we can then help you execute the strategy if you'd like. Of course, you could do it on your own. You don't need us to do it, but if it's something you'd be interested in, or if you'd like to learn more about working with us at Libertas Wealth Management Group, we'd obviously love the opportunity to give you a second opinion on your investment management, financial plan, retirement plan, estate planning, and tax planning. And by the way, when this is implemented, many times, this is something that's implemented over several years, not just 1 year. So it's definitely a strategy that needs to be babysat, not something that you just set it and forget it and you're done. So that's all we've got for today. I want to thank you so much for listening, please. Or if you were watching on YouTube, thank you for watching. Please feel free to share this episode with your friends and family. Obviously, a lot of valuable information in here, a lot of caveats and tips and tricks and, of course, myths that we wanted to dispel. If you'd like to discuss your personal situation further, remember that you never have to be a client to ask a question. If you'd like to set up an intro call with us or a Zoom meeting, head over to our website at libertaswealth.com to schedule something on our calendar. And as I always say, there's thousands and thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Be sure to subscribe on iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get these updates, as well as our other screencasts, videos, and articles delivered directly to your email inbox. Please feel free to follow us on Facebook at facebook.com/LibertasWealth. Again, I'm also on Twitter at Adam Koos, as well as Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.